Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy day and spend some time with us. I know the weather is starting to get better here in Canada and the U.S., and I know a lot of people are out and about, going to their summer homes, cottages, and going on vacation. So if you can take some time, spend it with us every couple of weeks, that is always the best recipe for success and to obtain some information. We like to answer the questions that people are presenting to us. We get a lot of questions from investors on a weekly basis. We gather up all those questions, and then every 2 weeks, as you all know, on Wednesday at 12 noon, we bring you the answers to those questions, and we use the questions that we receive to create topics, to create segments for our show. So we always try to present an action-packed, or I should say an information-packed show for all of you, action-packed as well, with some great guests. We have a great guest coming up on our next show, which we'll talk about at the end of our show today. But here are our topics for this week's show. Iran deal and what it means for the markets. We know that the Iranians and the Americans have signed a memorandum of understanding. This is an agreement between the two countries to basically further negotiate over the next 60 days a whole bunch of topics and things that the U.S. wants Iran to do. And obviously, Iran has some wants for themselves as well, some things that they need to see before they agree to any sort of end to the hostilities and the war. We're going to go over the deal and what it means for the markets. Top 3 things to consider over the next 5 to 10 business days. This is our very popular part of the show where I go over 3 things that individual investors need to be focusing on before you make your investment decisions. Who benefits from the conclusion of the Iran war? Well, I guess you could say the whole world does, but in particular, I think there is one area of the market that probably benefits most when this war ends, or even now when there is this, the stop of the war while this 60-day period is going on and things are being worked out. What can stop the market's rally? We talk about all the time, what's it going to take for us to get to the next level, for the markets to reach new highs? But we rarely ever talk about, well, we know what's driving the market now. We talk about it on pretty much all our shows, but what can derail this market rally? And I want to touch on some ideas that I have regarding that. Takeaways from the first Fed meeting for Kevin Warsh. What did he do differently? What is he doing? What do I agree with? What I don't agree with? We're going to talk about what came out of Kevin Warsh, the head of the Federal Reserve, his first meeting and press conference that came out in the last week or so. Quick hits, 3 things in the news that have caught my eye that we want to comment on. And last but not least, of course, your questions. If you have any questions during the course of the show, please put them in the chat boxes. My team will come around and pick up those questions. If you don't get a chance to answer your questions on today's show, we will definitely answer those questions on our next show in 2 weeks, or perhaps I will answer them throughout the next 2-week period before our next show. We always seem to get a bunch of questions, and I can only usually get to 1 or maybe 2 at the end of this show. So without further ado, let's move on to our first segment and this big Iran deal that we've been speaking about now for the last couple of weeks. So we know that a memorandum of understanding has now been signed electronically, and I think now in wet ink, I believe in Switzerland, between Iran and the United States. And what does that mean for the markets? Well, I guess in simple terms, it means great things for the markets. It means the market will move higher. It means the market is now anticipating that the Strait of Hormuz will be opened, that traffic will begin to flow through the strait. The big tankers that carry the oil to the rest of the world, whether it's Asia, whether it's Europe, wherever it is, that they can flow through the strait once again. And of course, the hope is that with oil being able to leave the strait, that will hopefully allow oil to get to their destination. Prices will hopefully come down. And with that, the hope is that inflation around the world drops as well. We started to see inflation rear its ugly head over the past month or so, maybe a month and a half, starting to see inflation on the headline numbers. We really haven't seen a lot of inflation on the core numbers when you exclude volatile food and energy. But overall, we've seen inflation, kind of trickle higher. Let's put it that way, trickle higher. So, what was in or what is in this memorandum of understanding? Let's go to our first illustration, our first chart. There we have it. Point one, obviously, an end to the conflict on all fronts. U.S., Iran, and allies declare immediate and permanent termination of military operations on all fronts, including Lebanon. That was a big one because, as we know, there's a lot of fighting going on in southern Lebanon between Hezbollah and Israel. And that, unfortunately, did not stop when this memorandum of understanding was signed. So there was some back and forth. Will this hold? The Iranians wanted to include Lebanon in their negotiation, whereas Israel and the United States did not want to include it. In the end, the United States has gotten Israel to the bargaining table, I guess, to talk to Lebanon. And right now, as far as I believe, there is some peace for now. Israel is still occupying many areas in southern Lebanon to deter the Hezbollah from attacking Israel. But from now, for now, I believe things are going okay. Whether or not that remains intact remains to be seen. Some other points to bring up: respect for internal affairs, respect sovereignty and internal affairs. So Iran says that everyone should respect their sovereignty, their right to remain independent and govern their own country. An extendable 60-day timeline. U.S. and Iran commit to negotiating deal in 60 days can be extended if certain things are not met. Strait of Hormuz has to be opened. No charges or tolls can be put in place by the Iranians. Money for Iran's reconstruction. This is an interesting one because many Republicans, this is where they kind of drew the line and saying, why should the United States pay for the reconstruction of Iran? Well, interesting enough, there are a lot of assets being held by the United States. They froze a lot of the assets the Iranians had. So as I understand it, they're now opening up or unfreezing those assets. And those are the assets that are going to go towards Iran so that they can buy food for their people, buy agricultural products, etc. And guess who they're buying those products from? From the United States. Once again, the United States benefits in this regard. They get to sell Iran different things from that is produced in the United States, from farming, etc. And obviously, the U.S. will benefit from that. End of sanctions. U.S. will terminate all sanctions against Iran. Timeline sort of unclear. Skipping down a little bit, we have the frozen funds. U.S. undertakes to make fully available frozen or restricted funds once the MOU signed. Procedures agreed to. Details to be finalized during negotiations. And last but not least, monitoring and final negotiations. U.S./Iran to create mechanism to monitor logistics of MOU and compliance with future deal. Final deal to be endorsed by the UN Secretary Council resolution. I skipped point 8. Actually, I should go back to that, which is probably the most important point in this whole deal. No nuclear weapons. Iran agreed to not procure or develop a nuclear weapon. Both sides agreed to deal with Tehran's enriched uranium. When that is going to happen is unclear, but I believe we've heard some information that nuclear and UN inspectors would go in to take a look at what Iran is doing on a regular basis, like it used to be a while ago. But these inspectors have not been able to go into Iran for quite some time. So obviously a good, this memorandum of understanding, a very good thing for the markets, a good thing for investors. What does it do? Well, let's go to our next chart, WTI crude. WTI crude, 73.32. I can tell you that coming on the air today, it was actually under $70. Now, keep in mind that WTI crude, so the price of oil, was around 67-ish dollars before the conflict in the Middle East started in and around March the 1st. So we are almost back to pre-conflict levels for WTI. Our next chart, Brent crude. This is the price of oil or energy in Europe. And we can see back under $80 a barrel. And once again, it was in the 70s when the war broke out. And you could see not far off where it once was trading. So again, Brent crude coming down, WTI coming down, with that hopes of inflation coming down. And then eventually, maybe, just maybe, we'll see interest rates coming down later this year. Maybe the Federal Reserve, right now, they're talking tough on interest rates. Maybe they start to lighten up or soften up over at some point at the end of the year. And some people are actually saying it's about a 50-50 chance whether they increase interest rates or cut interest rates. Interesting enough, I would be very surprised if we see an interest rate increase, although half of the Federal Reserve is now saying this at this point in time. But our last chart for this segment, when you look at the effect on the stock market, we have a 1-month chart of the S&P 500. Let's put that up. And you can see right in around the 10th of June, that is when this memorandum of understanding was looking to be a little bit more final. Looks like it was going to happen. And look at the S&P 500 just go up almost in a straight line from about the 10th, let's say, until about the 15th of the month. It has since come down, but for other reasons, not with respect to the war. I think you've seen the S&P 500 come down with respect to tech and a bit of a tech sell-off that we've seen in the last little while. So the Iran situation, the memorandum of understanding being signed by both the United States and Iran. What does that mean for the markets? It means pretty much only good things. Only good things coming out of this agreement. Many will say this agreement wasn't good, that the U.S. gave up too much, that the U.S. did not get enough. I'm not sure if that is the case. President Trump, believes that is not the case, that they will still be able to prevent Iran from obtaining a nuclear weapon. And at the same time, they're getting the reopening of the strait, the flow of energy or oil. They're getting a lot in the deal. And I know the president is happy with what's going on. Some others may disagree, but what's it for the markets? What's in it for the markets? Only positive things. And that's, I think, how individual investors should be looking at it. Now we come to the very popular part of our show, top 3 things for individual investors to be focusing on or considering before you make your investment decisions. And here you have our 3 for the show today. Inflation and GDP updates. We're going to get a very important inflation number out of the US tomorrow. PCE, personal consumptions and expenditures. This is a very important number for the Fed. It's actually even more important than the CPI data that came out recently. For different reasons. PCE doesn't factor in as much real estate as CPI does. So it strips out, or I shouldn't say strips out, but it doesn't account for as much real estate in its number as CPI. And we're also going to get GDP update. What happens is United States issues their first GDP number, then they have a second revision and a third revision. And on Thursday or tomorrow, we're going to get the third estimate or revision to the number. I don't anticipate it changing an awful lot, but obviously an important number that investors need to be focused on. Rapid market swings and volatility. We've seen a lot of them over the last little while. I think it's important for individual investors to focus on them, but understand why they're happening and not just follow the herd. Number 3, US dollar rising versus the Canadian dollar. And really, the US dollar has been rising versus all major currencies. I'm going to go into why it's happening and why the Canadian dollar is falling versus the US dollar. So let's move to our first point, inflation and GDP updates. I'm going to read out some data for you. As I said, on Thursday, we're going to get the numbers on GDP, third revised or third number. Third estimate or revised number for GDP. We're going to get PCE, a very important inflation number, but we already received some numbers already. Canadian CPI for May, 3.2%. Core still under 2%, which is very, very important. And I believe that allows the Bank of Canada to remain on hold. US CPI for May starting to tick higher, 4.2% on a headline number. So double what the Fed would like to see, which is normally 2%, and even core now approaching 3%, so 1.5 times more than what the Fed would like to see. US PPI numbers came in a little hot as well. Now, PPI are wholesale prices. This is before you get to see the item in the store. This is on the wholesale level, and we've seen PPI 6.5% higher. So numbers that I don't think the Fed would like to see, and keeping the Fed from cutting rates. And unfortunately, many think that these numbers will cause the Fed to raise rates before the end of the year. Our first chart, consumer price index. Canadian Consumer Price Index, as I said, 3.2% on the headline. You're looking at about 1.5 times more than what Bank of Canada would like to see. But again, because core rates are under 2%, I think the Bank of Canada is okay with it. Our next chart is Bank of Canada's preferred core inflation measures, and they remain stable near 2% target. You could see on the far right-hand side of the chart, things are starting to move higher. Obviously not good for the Bank of Canada, for all of us. We're seeing rising costs all around us, grocery bills, travel, filling up your car at the gasoline station. Everything's been going up and obviously not good, but still in and around the target rate of 2%. Next chart that we have, next illustration, this is US inflation and interest rates. I like this chart, one of my favorite charts on the show today, because it kind of shows everything all in one. Core actually shows headline CPI, which is in red, 4.2%. It shows core CPI, which is in blue, 2.9%. And you can see what the benchmark interest rate is right now in the US. Now, if you're wondering, doesn't the US give us a range versus a number? It does. We know the range is 3.5 to 3.75, and that's why you see 3.62, which is middle of the range. And coincidentally, the interest rate is in the middle of the range between core CPI and headline CPI. So which way is interest rates going to go? Is it going to go higher, or is it going to come lower at some point, perhaps by the end of this year or early next year? That is the question. And we look for different, information or hints from the Federal Reserve on a regular basis so that we could tell which way they are leaning. Next chart is on PCE, the big number we're going to get tomorrow. This is PCE change from month 1 year ago. You can see starting to rise, 3.8%, 3.3%. So over the last year. US PPI, our next chart. These are the wholesale prices, and you're going to see those prices really moving significantly higher. Why aren't we seeing that in the inflation data? My guess is that a lot of companies are swallowing these higher costs and only passing through a percentage of these costs to the end user. When you start to see inflation moving higher, whether it's PCE, CPI, PPI, what ends up happening right after? You get interest rates moving higher in anticipation of the Federal Reserve, Bank of Canada moving interest rates higher. Our first chart on interest rates shows the 5-year rate, and you can see how much the 5-year Treasury, there it is, has moved higher. Yes, it's come down a little bit because the hope is now that the war hopefully is over, that oil prices come down, inflation comes down, and interest rates hopefully follow. 5-year rate is usually moves in anticipation what the Fed has to say and what the Fed does. The 5-year is a good indication as to what the market believes the Fed will do. 10-year Treasury, which we have our next chart, also shows it moving higher, coming down a little bit like the 5-year. Again, when you start getting out longer term, the Fed doesn't have as much of a direct effect. 10-year and 30-year, these are more market moving. The market will figure it out, and the Fed pretty much, I would say, really controls more directly the 2-year and the 5-year. Our last chart for this segment, as we said, big number on inflation, but also the third revised reading for GDP for the first quarter. Real GDP percent change from preceding quarter, there it is. We're expecting somewhere around 1.5%, maybe can be revised up to 2%. We had a really weak number in quarter 4 in the US, but still, these are all positive numbers except for Q1 last year. We know in Canada, we are in a technical recession, as they call it. Technically, we are in recession, although I'm sure most people don't feel much different from this quarter or a couple of quarters ago. Things have been difficult now for a number of quarters, but we've seen red with respect to the last quarters for GDP. So let's keep an eye on that inflation data coming out tomorrow. The second point I wanted to stress for individual investors to be focusing on is this idea of market volatility. Market volatility has been unbelievable. You wake up in the morning, market is up 200 points. Somebody says something, the president tweets out something, you get a comment out of Iran, something on the geopolitical side, we go up from being up 200 to down 300 in a matter of moments, matter of minutes. The market is so volatile right now. Or perhaps economic data is released at 10 o'clock or 9:30. Market opens higher. Economic data is a little soft. Market goes down. Or on the flip side, perhaps the market opens up down quite a bit, like we saw the other day. And throughout the course of the day, people come in, investors come in, retail investors especially come in and buy the dip, and this market moves significantly higher. Our first chart, again, a 1 month of the S&P 500, and look at the volatility. We had that spike on the 10th, or from the 10th, then back down. A lot of this is on the back of the ups and downs of technology, AI spend, and the whole 9 yards there. It's just unbelievable volatility, and definitely not for the faint of heart. For me, you got to be careful with volatility. You can't make decisions based on that. Our next chart, the NASDAQ, also will show you tremendous volatility in the last little while. And last but not least is the S&P TSX, a little longer term chart, but you can see that the volatility is not as great, but definitely a lot of ups and downs, throughout the course of the last few months. So why is the volatility happening? Well, I think it's because of our next illustration showing the headlines that have come out. We've seen a lot of headlines coming out. I'll read you some. Iran is closing the Strait of Hormuz again. America's big mistake in Iran. Exports warn. There they are. Experts warn of U.S.-Iran deal faces major obstacles after the latest Strait of Hormuz closure. All negative headlines. Market drops. Market moves to the downside. Then you get first round of U.S.-Iran talks end with encouraging process, mediators say. And you get the U.S.-Iran negotiations have been chaotic, but the confusion has grown into an agreement. An agreement was signed. Again, negative and then a positive. This is what the market has had to parse through over the last little while. A lot of headlines, geopolitical headlines, a lot of media reading into these headlines up and down, and no wonder the market has had difficulty. But one thing I wanted to just tell everybody, kind of a bit of a story, talking to an investor not that long ago, and just goes to show you what type of the headlines and what's going on and what media is saying and how much of an effect it's having on investors. This investor came to me and said, Allan, I just don't understand or see how tech stocks can fall. Why do we sell off some of our winners or trim some of our winners when I just don't see tech falling? Tech is going to go up and up and up. What can take it down? And I said, you make a good point, but as I say, every dog has its day, and things don't go straight up to the moon. And at some point, tech will pull back, and with that, the market will pull back. And sure enough, a week or so later, we started to hear some rumblings. Maybe tech spend is too high. Can tech remain as strong as it has, etc.? Maybe there should be some rotation into other areas of the market. And we saw tech sell off. And same client, speaking to, said to me, oh my goodness, maybe this rotation is for real. Maybe we should be selling tech. So we went from buying tech, staying in tech, it's never going to go down, to maybe we should sell tech because we saw a rotation. And that is, in my opinion, what the media had been saying that day or that week, saying that a rotation is underway. Well, guess what happened shortly after? Tech went right back up again. So you just can't follow the volatility. Well, you can follow it. You just can't, follow it in terms of do what the media is saying to do. Maybe you should get out. Maybe you should get in. You have to really evaluate why this volatility is happening, why the market swings are happening. You can't just follow the herd. You have to do your homework and your research. And that's what we do at the Allan Small Financial Group every day. We want to know why things are moving to the up and to the downside. And we also know that sometimes there is no reason why things move. They just do. One day you wake up and you want to sell your Micron shares or your SK Hynix shares over in South Korea. And the next day you wake up and people are buying the same two stocks. Any news come out? No. But that is just the way it goes sometimes. That's why on a short-term basis, things can get very volatile and decisions need to be made more on a longer-term basis than on the short-term basis. Our third point that I wanted to headline before you make your investment decisions, and this has to do with the strong US dollar. Why is the US dollar gaining so much strength? It had lost a lot of strength over the last couple of years, which is why coincidentally, price of gold has moved up as much as it has. And now that the US dollar is back on top and moving higher against all major currencies, especially our dollar here in Canada, price of gold has fallen down 25, 30% from the high. I actually saw it under $4,000 an ounce. Keep in mind, gold reached over $5,500 an ounce not that long ago. Silver has also come down. So we've seen that these metals that are priced in US dollars really start to fall as the US dollar has gained strength. So why has the US dollar gained strength against the Canadian dollar and other currencies? Well, I have some ideas. Number one, probably the most important one, is the Fed. The Fed has now said that more than likely they will not be cutting rates this year. It was anticipated that Kevin Warsh would be cutting rates this year when he took over for the Fed, but it looks like with inflation pressure there, with 50% of the Federal Reserve governors saying they should not be cutting interest rates, and in fact, many of them saying maybe an interest rate hike is in the cards, we've seen US dollar strengthen on the back of potential interest rate hikes. Ending of the war in Iran. As I mentioned to you, the United States has said, sure, we're going to let Iran tap into their frozen assets that the U.S. had frozen over the last little while. They were trying to squeeze the Iranian economy to get Iran to the negotiating table. Did it work? Well, I guess it did because Iran is at the table right now. These assets will now be unfrozen. And where are they going? Where they're going to go to the United States to buy food, agricultural products, and other products out of the US. Again, a benefit to the United States, just makes the United States even stronger. They also allowed Iran to sell oil in US dollars. Very, very important. Iran has not been able to sell oil in US dollars for decades. So again, a big winner for the United States. The United States, over the last little while, they had already been the largest producer of energy in the world, but now as they went into Venezuela and took out that regime, and now they're working with the Venezuelans to produce even more oil and energy for the rest of the world, that only, again, strengthens the US, strengthens the dollar. And last but not least, AI, right? All we talk about is AI. I believe the United States is the most powerful country with respect to artificial intelligence. We know the Chinese are very close behind and in second, but this just continues to power these businesses, these names like Nvidia and AMD and Google or Alphabet and Amazon and all these big major companies to new and new highs, trillions of dollar market cap. Again, just continues to strengthen the United States and the dollar. On the flip side, why is the Canadian dollar weak? Well, US is gaining strength, and unfortunately, we seem to be losing a little bit of strength. We are technically in a recession right now. We've had 2 negative quarters of GDP. Also, we are looked at as a petrocurrency. As the price of oil falls, as the Strait of Hormuz reopens, that is not good for our dollar as well. So a couple of negatives on the Canadian side, not to mention Kuzma. What's going to happen with tariffs and trade between the United States and Canada? Right now, not looking so great. Hopefully a deal can get done, but in the meantime, it unfortunately makes our dollar a little weaker. So let's go to a chart. The Canadian dollar, actually we'll look at our US dollar index first. This is the strength in the US dollar. Look how well the US dollar has done on the far right-hand side. If you go all the way back to just before February of this year, look how great that chart looks. Almost looks like a tech stock. And I actually had a client call me the other day and said, you know what one of my better performing investments has been? And I said, what? He said, the US dollar. Just the fact that he owned US stocks. Not only did the stocks go higher, but he also made money on the currency conversion as well because he used Canadian dollars to buy the US dollar. Our next chart shows the Canadian dollar. and it shows it at 70 cents. And as I said, I saw it below 70 cents before I came on the air today. And I just don't see for now how the Canadian dollar will gain some strength versus the US. I've said to many that I anticipate a 72 to 75 cent dollar. That's the range that I anticipate. It's gotten below that a little bit. I'd be very surprised if it went above 75 cents at some point in the near term. But I think it's possible for the Canadian dollar to work its way up to back to that range once again. So currency is something to focus on. The inflation data coming out tomorrow, extremely important, and rapid market swings. Don't get caught up in them. You don't want to do things, follow the herd. You just don't want to move for the sake of making a move. You want to understand what's going on. And that's the job of the investment advisor, right? That's my job, to make sense out of things for all of you. For those that have their own investment advisor, that's where you go to them and talk to them about what you should be focusing on before you make your investment decisions. That's kind of a loaded question, right? Who benefits from the conclusion of the Iran war? My opinion is the whole world, right? Obviously, nobody wants to go to war. There are many lives lost, or there can be. Look at the war with respect to Ukraine and Russia. In Ukraine, how many lives have been lost? It's just an unfortunate thing, and that war is still continuing. As ugly as it is, it's still continuing. So when I say who benefits from the war the most, I would say the whole world does. There's no doubt about that. The ending of the war, as I just showed you, hopefully will eventually bring down inflation. It's a bit of a laggard, so it will take some time, but the hope is that is the case. But outside of that, in my opinion, and we can pull up our first chart here, and only chart for this segment, I think Asia and Europe benefit a lot more than we do here in North America. Why is that? Well, the United States is self-sufficient when it comes to energy. Canada, very large energy producer, oil producer as well. Whereas places in Europe, for example, do not produce energy, do not produce oil. I should say oil, not energy. Do not produce oil. They are not self-sufficient. So they have to rely on countries to export oil to the UK, to Spain, to countries in Europe, so that they can heat their homes, they can do all the things they need to do on a day-to-day basis. Asia is the same thing. Japan, China, very big with respect to oil coming out of the Strait of Hormuz. A lot of the oil goes to China, goes to Japan. Very important. And that's why President Trump made the comments when he did, saying, where is NATO? Where are our allies? Why aren't they helping us, in the Strait of Hormuz? Why aren't countries coming to help the United States monitor the strait and allow tankers to get out? And Donald Trump, or President Trump, said, you know what? We don't need it as much as you do. You should be here with us. And we noticed, or we saw, that that was not the case. Now the strait is open once again. And this chart is really, really good to show us the dependence of Europe on the strait being open. So what does this chart say? Well, this is the Stoxx 600, the largest index in Europe, when it trailed the S&P 500 for 3 straight months before June. The black bar there is June. And what this shows, the Stoxx Europe 600 index minus the S&P 500 index monthly returns. So when the bar is going up, you know that the Europe index is outperforming the US, the S&P 500. You could see from a period of April till about September last year, the S&P 500 outperformed. So US outperformed Europe. Then once again, Europe outperformed for a period of months. And then this year, once the war started, you could see in and around March is when Europe really started to fall. There really was underperformance of European market to the US market. And we know this, right? We know that Europe is a lot more sensitive to what was happening in the Gulf, to that oil not being able to get out. And now look what's going on in the month of June. The European market is outperforming the S&P 500 once again. So what does that mean? Well, I think it should be telling countries in Europe they need to find another source of oil, that they just can't rely on this narrow passage, Strait of Hormuz, for most of their energy needs. Maybe they should be talking to Canada. I'm hearing that that is actually the case. Maybe they should be getting their oil from Venezuela or from the United States or somewhere else and not have to rely so heavily on the Strait of Hormuz. Because as we know, the Europeans, as you can see by that last chart, clearly rely on that strait being open to get what they need so that their economies can continue to grow. And obviously, as we see, their stock market can grow as well. So what can derail this stock market rally? You know, the market's been rallying so hard over the last few months, even in the face of the conflict in the Middle East. I was talking to another investor recently over lunch, and they said to me, Allan, you know, with the conflict now ending, you know, we saw the ups and downs in the market while the conflict was going on, but now with the conflict ending in Iran, if this memorandum of understanding can go through and they could come to an agreement on the nuclear ambitions of Iran, etc., what's to stop this market? And I laughed a little bit and I said to the client, I said, you know what? Really, yes, the market has moved up and down with the conflict in the Middle East, but you got to understand that investors have to understand that the market has probably moved even more so with technology, AI, AI spend, AI valuations, AI return on investment, all the things we've been talking about with respect to artificial intelligence, its disruptive capabilities, the software sector, other areas of the economy, whether it's freight, whether it's legal, whether it's you name it. What can AI do to disrupt the economy? What can tech do? How much higher can tech go? How much higher can companies spend on AI, can spend on compute? So to me, this has been, or that idea, technology, AI, to me is much more important and can be the thing that brings down the rally, or at least stops it, puts a pause on it, whatever you want to say, because I don't think that tech will go to the moon. I think at some point tech spend will slow, and with that, I think the market may slow as well. So what can derail this rally? Let's take a look. Our first chart. We have hyperscale CapEx. This is the amount of money that Amazon, Google, Microsoft, Meta, and Oracle are spending. And you can see all the different shades of blues pretty much. But the main number is where it's at. So back in, I guess, fiscal year 2022, 158 billion. It actually went down in 23, but look how high it's gone since then. 2024, 25, 26 expected to spend $760 billion. Doesn't stop there. It gets up to over $1 trillion by 2028. And you see here the Huang prediction. This is Jensen Huang, actually. His prediction as they will have spent $4 trillion, the hyperscalers would, by, I guess, by 2030. So they're not predicting a slowdown in spend, but I'm telling you that if we do see a slowdown in spend, and it doesn't have to be a major slowdown, or maybe not even a slowdown, but just status quo. What happens if in 2026 we don't, the predictions are 760 billion? What if it comes in at 500 billion instead of 760? Will the market sell off? The answer could be yes. So you always end up becoming a victim of your own success. At some point, the spending must slow down. They just can't spend forever. We know a bunch of these companies are already spending more than they actually take in, like Amazon, for example. And so they actually have to issue debt, sell bonds to raise money so that they can spend more on compute and data center and AI. Another idea, something that we see often, not just in tech, but in other areas, we saw it in 2008 with the financial crisis, is greed. Our next chart shows leveraged ETFs, assets under management. What does this mean? Well, maybe a bit of a complicated chart, maybe not. But what this shows is that more and more investors are borrowing money. They're leveraging. They're buying leveraged ETFs, getting more money to work for them in the areas of technology. The biggest we've seen recently has been out of South Korea. A lot of leveraged products, a lot of borrowing to put more money to work. Yes, I believe this time is different in that, like we've seen in other times with the internet and industrial revolution, this whole AI boom is a time that investors can and will make a lot of money. We're seeing it happen right in front of our eyes, but you got to be careful. If you get too far ahead of yourself, get too far over your skis, and there is a pullback of 10, 15%, which can happen and will happen at some point, more than likely, then individual investors can get hit if they're losing leverage, using borrowing to invest. Not necessarily a great idea at times. Next chart I have is the 2-year Treasury rate. What also can derail this market? Well, inflation is an issue. If the Fed decides to raise interest rates, I believe this could cause the market to pull back. And I would say because of how high and how fast the market has gone higher recently, expect the same kind of pullback, very fast and abrupt. So as long as treasuries are going down, and on the far right-hand side, you can see the 2-year is falling a little bit, but the trajectory definitely has been higher, and that is anticipation of the Fed raising rates at some point this year. The next chart we have is the 5-year, showing the same thing, showing a gradual increase. We have the 10-year as well, showing a gradual increase. We go to the 10-year there. There it is, and we show a little bit less of an increase because, again, it doesn't necessarily follow the Fed as much as the short-term rates do. Another area or something that I'm always keeping in mind, stock valuations, right? Our next chart shows PE ratios for a lot of the companies. Now, a lot of the companies like memory chip companies have gone to the moon, up 200%, Micron year to date, SanDisk up hundreds of percent year to date. Yet their forward earnings multiples, so their PE ratio, forward PE, is not that expensive. It's actually trading less than the S&P itself. Once upon a time, Micron used to trade at 7 times forward earnings. Today, it's in that, that 15 to 20 times range, but still less than the general market. So we want to keep an eye on PE ratios, valuations, especially as he says here, company comparison in the semiconductors. That is where some of these companies like an AMD have really shot to the moon. Next chart shows S&P sector performance. And as you can imagine, tech stocks have really hit the home run, more so than anything else. If you look at a year to date, information technology leads the way. Actually, no, sorry. The energy sector leads the way, and that's obviously on the back of the situation in the Middle East. But that probably will, and already has probably come down quite a bit. But we're seeing a lot of things. Consumer discretionary has had a bit of a tough time. Communication services, a tough time. But as I said, it's that information tech, infotech has been leading the way with respect to the market. So what can take this market down? A number of things. We always got to be watching. And, as a money manager, as someone who invests money for individual clients, we're also risk managers, right? We keep one eye on the opportunity and the idea to try and to grow individual portfolios, looking for growth. But on the other side, we're always looking at risks. What are the risks to this market? Short-term risks, longer-term risks, risks that might be short-lived risks, meaning you see a bit of a quick downturn and then followed by a move higher. We're looking at all these things, and all money managers all investment advisors should be looking at these types of risk. And these are the things that I think can possibly take this market down. But make no mistake, I'm not saying to get out of the market and sell your investments because of these things. I'm just saying we need to be mindful of them and keep an eye on them. Takeaways from the first Fed meeting for Kevin Warsh. My biggest takeaways were pretty simple. He spoke very abruptly, very short, did not give a lot of detail, not as much as his predecessor, Jerome Powell. He talks about not speaking as often, not letting the public know what's going on as much. And I think that's a negative. I know that Kevin Warsh says it's a positive because it does not, I guess, put the Federal Reserve into a corner, doesn't back them into a corner where they have to do something because that's what they said at a press conference or a latest meeting. They want to have flexibility to be able to change how they think and change what they do. And I understand that. But at the same time, in a world where everything is transparent, where we get news at such a fast pace, I think the Fed should be transparent and should be providing us with as much information on how they are thinking versus, not saying anything and having us all try and figure it out on our own, which could be a bit of a disaster at times. So our first illustration here shows you what the new head of the Fed, Kevin Warsh, has done. So on the right-hand side, Federal Reserve issues their statement. Look how small that statement is versus on the left-hand side, what that statement actually started off as. And then the Federal Reserve Chair Warsh shortened the Fed rate statement into that. So you can see a lot more detail on the left, crossing out a number of things and coming up with what he said on the right. Do I like that? Personally, I would say no. Maybe that does give them flexibility. Maybe that allows them to be more effective. I don't know. But for me, I rather have transparency always. Our next chart shows that maybe Kevin Warsh, we thought he was going to cut interest rates, but maybe he's going to be in favor of raising interest rates. We know half of the Fed perhaps is looking to raise rates. The other half is looking to stay status quo. But when we parse through Kevin Warsh, head of the Fed, what he said, look at what came out. Inflation versus labor. This is our press conference mentions of inflation versus the labor. We can see he's been more focused on inflation. What does that mean? Well, maybe that means an interest rate increase. Our next chart shows Federal Reserve policy interest rates. As I said earlier, it's always a range, 3.5 to 3.75. It's been in that range for a little while. Next chart, very interesting. I think a couple of times a year, Federal Reserve gives to us their dot plots. And what this is, each dot represents a Fed member. And yes, Kevin Warsh was not, I shouldn't say yes, he was not a part of this. Specifically, it says there, Federal Reserve Board FOMC release economic projections. Kevin Warsh is reported to have not submitted a dot for what he predicted. But to me, the most important thing is, and for the markets, if you look at 2026, so the dots on the left-hand side, you will see 3 dots under the 4% line. So that's coming in just under 4. You will see 5 dots above 4% and 1 dot in and around 4.5%. So what does that mean? Well, that tells me that 3, 8, 9 different Fed officials are predicting interest rate hikes at the Fed right now for 2026. Yes, we do have about 8 predicting things would stay the same or predicting that things will stay the same. So there's your 50-50 split. And you can see going forward what the dot plots tell us. Well, it tells us that by the time we get out longer term, interest rates will be lower than 3.5%. So very important to look at the dot plots. This tells us what the Fed officials are saying. Our next chart, our chart that is coming up, illustration, next one is the rising Fed rate hike expectations may simply reflect a strengthening economy, which some people think it does. You could see that the rising Fed rate hike expectations on the far right-hand side starting to move up in this chart. And that, again, tells us that the Fed may be now more likely to raise interest rates than to cut. So another thing to keep an eye on, obviously, we talk about the Fed all the time. I didn't put it necessarily in our top 3 things to consider, although I did put inflation there, which leads to possibly an interest rate hike down the road. So all these things are related. They all come together. And that's why we love economics, right? Economics 101, trying to figure out the pathway for the Bank of Canada, for the Federal Reserve. And right now, unfortunately, for the markets, the next rate movement just may be an interest rate hike. Quick hits, three things that I've seen in the news over the last couple of weeks that I wanted to comment on. Brexit 10 years later. Wow. Can we believe that? Brexit has been 10 years later. How the UK economy and politics have changed. We're going to show a chart on how the UK has fared. US allows Iran to sell oil in US dollars for the first time in decades. This was a Wall Street Journal article. We've talked about that a little bit already. Bank of Canada to put a hold on rates as 33% of gas inflation masks the weak economy. So what are we seeing? Maybe a stagflationary type of situation, higher prices, but a weakening economy, as we've said, as we all know now, technical recession here in our country. And we're going to touch on that as our third quick hit. So let's move to our first one and our chart for this topic, I guess, which is how the UK has fared since Brexit. And here you have the EU referendum, markets went higher, and then the COVID pandemic, boom, down. But overall, if you were to look at the UK and its performance, definitely underperforming other countries. And if there was estimates done on how the UK would have performed if there was no Brexit, which is the yellow line, you could clearly see here that it would have outperformed. So what does that mean? Should the UK have done Brexit? Many people believe that people were confused. They didn't know what they were voting for. They thought they were voting for something totally different. And so maybe Brexit should never have happened. We will never know because it did happen. And I guess life goes on and we have to deal with the consequences now, or at least the UK does. They just lost their current prime minister. They'll have to have a new election coming up in the UK for a new prime minister. We'll have to see. They've had a few prime ministers since the Brexit time. So hopefully they can gain some stability there. Our next quick hit coming up, U.S. allows Iran to sell oil in U.S. dollars. Very, very big. This is something that the U.S. Treasury is going to monitor. Obviously, they're allowing this to happen. U.S. Treasury on Monday issued a whole wide-ranging 60-day exemption allowing Iran to produce and sell crude oil, petrochemical, and petroleum products in U.S. dollars through to August 21st. Very important for Iran. It allows them to access different markets and a positive for their economy. And our third quick hit is this idea of the Bank of Canada to put a hold on rates as 33% gas inflation masks weaker economy. Here you have commentary after the latest Canadian CPI report. The Bank of Canada can live with headline inflation elevated in a range of 2.5–3%, so long as core inflation remains where it is, which is less than 2%. The economy looks soft, and business expectations about future price increases aren't excessive. So they don't believe that they're going to see a even further increase in prices. At least the Bank of Canada doesn't. As long as core inflation shows the numbers that it's showing, we're seeing that the headline inflation is obviously oil affects that, but oil has not. Higher oil prices still have not seeped into the core numbers as yet. And according to the Bank of Canada, that's what they're looking at. So three quick hits, three things in the news that I wanted to comment for all of you. Perhaps some of you may have seen them yourselves. What's my take? Part of the show where I take as many questions as I can from our audience and over the last couple of weeks. And I actually have two here, and they're very similar. So I kind of wanted to roll them into one. This person says, I find investing in the market very stressful, but my friends and family tell me to stay invested. Do you have any tips on how I can manage my anxiety about the market's ups and downs? We talked about the volatility in the market. And the second question is, how often do you recommend investors check on the performance of their investments? Well, I can probably tell you those that check on it day to day, they probably feel the anxiety a lot more than those that may look at it once a month or once a quarter. The day-to-day ups and downs probably affect those people a lot more. So I don't really have a recommendation on how often you should be checking your portfolio. I'm going to say whatever is comfortable with you. How often you want to check it is totally up to you. But how do you manage the anxiety? Well, I think, as I said earlier, you have to understand that when you hear negativity in the media and in the news or see it on social media, it's never as bad as what it reads. On the flip side, if you see a lot of positives out there, it's it's probably not as positive as how it sounds as well. The people that are writing a lot of the things that you read are trying to be more provocative. They want to get more eyeballs to what they're writing. They want more viewership. And so they're going to write whatever it takes to get that viewership or those eyeballs reading that article or reading what they write on social media. So understand this. Maybe you don't look at your portfolio every week, especially if you know that there's volatility in the market. Maybe you look at it in a couple of weeks. And I think that is probably the best way to manage your anxiety. So with that, I want to say thank you to all of you for tuning into our show today. As always, we will be back with you 2 weeks from today. Again, Wednesday at 12 noon. That is Wednesday, July the 8th. We will have a fantastic guest for you. We will have Heather Exner-Pirot. She is the Senior Fellow and Director of Natural Resources, Energy, and Environment at the Macdonald-Laurier Institute. She's going to talk to us about critical minerals, something that has been in the news for quite some time now with the United States and Canada, all the critical minerals that we have here in Ontario that the Premier is trying to tap into and use as a source to sell the rest of the world. So we're going to talk about critical minerals race. We're going to talk about what's happening in pipelines in Canada. Promises to be a fantastic show. Hope you all can tune in again. And until then, happy investing.